Hi there, this is your buddy Professor Bill again, and we're thinking in some detail now about Chapter 13. We're thinking about current liabilities and contingencies. One thing you should remember from your principles class is that current liabilities, the subject of Chapter 13, are those liabilities to be settled in 1 year or less. Long-term liabilities, on the other hand, are the subject of Chapter 14 and not discussed here. Here are some thoughts about current liabilities for you to just remember and not forget. First, with regard to accounts payable, there's no contract. So people have often asked me, more in principles classes than intermediate classes, what's different about an account payable and a note payable? And my answer to them is that the account payable doesn't have a contract. Very often it is to be settled very soon. The water bill, for example, could be an accounts payable if we received a bill and haven't paid it yet. Notes payable, on the other hand, are evidenced with a contract. Usually that contract stipulates some interest, and an account payable we don't typically have interest. And finally, in a note payable, there'll be a maturity date. Maturity date's in a year, within a year, it will be a current liability. If the maturity date is in more than a year, it'll be a long-term liability. And consider this. If the structure of the note is that there are 12 payments in the next year, but maybe 60 in total, then the first 12 are current and the last 48 are long-term. So you could have one document, one note, and two liabilities. Accrued liabilities are a little bit different. These are things that may be set up like contracts and then a time passes. Let me go back to the insurance example. So most reputable insurance companies will allow you to pay off a loan early, which means if you set up a note with them and you pay it next month, then you don't pay interest. Well, the 12 principal payments then are contract liabilities. You owe them. But the interest payments are not contract liabilities because you only owe them when time passes. If you pay them off, you don't owe them. If you don't pay them off, you do. So typically we'll have things like accrued interest, which again is separate from accrued principal. Here's some other liabilities that are usually current. Advanced collections. So for example, a sports team quite possibly would ask you to buy a season ticket in advance. Think about ODU football or basketball. And if they do, then the company would debit cash and they would credit a liability until the game's actually played. The gift cards that you may have bought or received during the holidays from Target, Walmart, other places, when the company sells you the gift card, they've collected cash, but they also have to record a liability until you go in and use the cash for merchandise. Well, now let's shift to the most controversial topic in Chapter 13. So, we're going to spend a little time, and you're going to see that some of your exercises deal with the things we just talked about, but a lot of that's review from principles of accounting. But here we have some new stuff. Particularly, we're going to dwell on loss contingencies. And we're going to learn with these loss contingencies that sometimes we may have to actually do a journal entry. Other times, no journal entries required, we just disclose. It means a footnote. And the possibility exists that we could even ignore the loss contingency. Know it's out there, but not do anything about it. Notice I've given you some hints here. If we come to believe that the loss contingency is probable, and different books are set up different ways, but I've always looked at probable as having two conditions. First, this event is likely to happen more often than not. It's more likely than not that it will happen. And second, we know the dollar amount. Now, some books, and I believe yours is one, actually switches that out, and they say that that's, that probable simply means, is it more likely than not? And the dollar amount is a separate event. But to me, it takes both things to make it probable. It takes both knowing the dollar amount within a range at least, and considering it more likely than not. And if you look, even though I'm saying it a little bit differently, what I'm saying is not inconsistent with the book. Well, it could also be deemed that a loss contingency is reasonably possible. And if it's reasonably possible, just as likely as not, that means we're going to disclose it. Put a footnote out there, but not a journal entry. And if it's a remote chance that there'd be a loss contingency, then we'll ignore it. Well, you might be asking at this point, what are we talking about with contingencies? What is a contingency likely to be? And to me, the most common one is legal. So the most common one is the company's been either threatened with a lawsuit, and I mean a written threat, not just an idle threat, or they actually have they've been sued. In each case, legal work is done. That's a triggering event for considering whether it's a loss contingency. So here's the probable example. I'm going to tell you in a minute that the probable category is not often used, and I'm going to tell you why at that time. But imagine that we do have a probable event, and the event is likely. So here you've got Bill, ABC's own company president, on a Justice Department tape trying to fix prices. So he's called a competitor, and the competitors are trying to fix prices. Clearly, you've heard in earlier classes that this is an illegal event. So it might be that the company considers it probable they'll lose, and they already realize that fines in similar situations are $1 million. In this case, they need to do a journal entry. They need to debit fines expense and credit legal payables. Now I want to point out here that you might call this an account payable. Normally for big things like legal payables, I would have a separate payable account. It's still current liability. This one's a current liability. But it would not show up mixed in accounts. Accounts would be things to me like sales, like cost of goods sold purchases that I need to pay for, and perhaps the water bill. But accounts payable would not include rare legal bills. Notice though, this debit to an account called fines expense, sometimes you might call it legal expense, is really going to be an adjustment to income. So if you look in the back of the book, or look to where the chart of accounts is listed, or go back to your principles book and look at that, you may find that there's no account called fines expense proposed by the authors. Now, I nonetheless believe that companies are free to set up any account they want, as long as the people doing the accounting understand it, and as long as whenever they do a financial statement, whether it's a management statement or a financial accounting statement, that the people that they're presenting the statement to understand. So I might move this to accounts payable when I'm doing a financial statement, but I would want it in a separate account, and I'd want the fines expense in a separate account, even if I called it legal expense on the financial statements. And let me explain why. Very, very often, a business will do a tax return and its financial statements from the same general ledger accounts. Well, fines expense is not a tax deductible expense. Other legal expense like paying attorneys is deductible. So I would have a general ledger account full of deductible expenses and another general ledger account full of non-deductible expenses like fines expense. And then I'd go ahead and perhaps put them together when I did an income statement. Either way, notice this is $1 million hit to the company. Well, in that case, we didn't know the outcome because the case hasn't been tried yet or settled. But what happens if it's a more than remote chance that we're going to lose, but it's less than likely? And also, what if we have an amount or range of possible losses? Well, in this case, if you look at what I've done at the bottom, the company is required to do a footnote disclosure. So notice you have Note 7, Commitments and Contingencies. And I'm going to read this to you in case you're having trouble with the words I've written. ABC has been sued by Bill, an employee, who alleges age discrimination. It's not clear whether the company will prevail. If Bill prevails, it's not the company, of course, loss may range from $500,000 to $2 million. So just to point out, this is totally separate from what I showed you in the last slide. Last slide, Bill was a different guy. He was the company president. This time, he's merely an employee, and he's suing age discrimination here. Now, honestly, if you don't know the amount, you would be free to change the last sentence to, the amount of any award, if it happened, would be unclear. I want to point out that this distinction, deciding whether a contingency is reasonably possible, probable, or remote, is often the subject of fraud. Because if you merely make the claim that it's reasonably possible, and you have any reasonable basis to claim that, obviously you don't have to put anything in the financial statements. But later on, if the company loses a lawsuit and goes out of business, then investors might claim you should have known all along that this was probable, and you might get sued. Here's a generic note. This is what you more often than not see in financial statements. I hate this thing. And as I was looking through your Air France case and assigning you your case study on it, thankfully I didn't see this. They had a little bit more meat to their commitment and contingencies notes. But look at this one. It's very common. ABC is a party to several litigation matters. It believes it should prevail in all of them. It's possible that a lawsuit or lawsuits could be lost. ABC cannot estimate a range of losses. Really? So what you've done here is just imagine that you have two lawsuits like let's imagine you have two or three that were reasonably possible. This Note 7 does not cover probable. So if they had a probable loss, the company had a probable loss, and what they did is did not record the liability and did this Note 7 instead, that's fraud. But it's not fraud to take that more descriptive, reasonably possible note on the last page, and maybe you have 2, 3, 5 cases like this. Instead of disclosing all 5, like we did on the last page, just make this generic note. Now, obviously, this is fraud too if you could estimate a range and you don't. But consider this. Who would prove that you could estimate a range and didn't? It could be very hard. Please note, and this is what I told you earlier, that attorneys advise firms against the probable losses distinction. And so this has been a problem almost since this standard was set. Wasn't long after it was set that a company tried to use it, and the attorney for the other side was able to claim the company admitted guilt because the company said, hey, we're likely to lose this. So what really happens a lot is that a firm that's doing a financial statement and works with attorneys, has a law firm that it works with, will go out and ask for an attorney opinion. And the attorney opinion will, the attorneys will write whether they believe anything is probable, reasonably possible, or remote. So if an attorney puts his or her stamp on nothing probable, only things that are reasonably possible and remote, you could imagine the legal hurdle that would be necessary to prove that the attorney committed fraud here. So you see, by the accountant being willing to pay some money and asking a law firm to write them a note about their cases, the accountant removes any chance that he or she will be liable, and it's extremely difficult to prove that an attorney committed fraud here. So that's a common technique, is that the accountants don't mess with it at all. They turn it over to the attorneys. A subsequent event note. Now, a subsequent event note to me is not exactly a commitment or contingency, although commitments and contingencies that unfold become subsequent events. But I don't know of another place where this is discussed in your book. So I went ahead and took it here because I've seen the discussion of subsequent events in your book, although those subsequent events more closely relate to commitments and contingencies than the one I'm going to describe. So here you have note 8. You would not have a note 8 like this and a note 7, and I'll tell you why in a minute. So note 8 says, on February 1st, 2016, now keep in mind, this is important and I'll tell you again later, but this, a company who's doing a calendar year financial statement, January 1st, 2015 to December 31st, 2015, it'll take them 45 to 90 days to do that financial statement after year end. So a statement that ends on December 31st won't be issued to the public until, somewhere around February 28th is where I'm showing this one issued. Could be as long as March. So go back to on February 1st, 2016, after the year ended, this is stuff I'm adding here, it's not in the footnote. After the year ended, but before the financial statement was issued, ABC was found guilty of discriminating against Bill and fined $2 million. So you remember, I obviously took the same set of facts, Bill claiming discrimination against the company, the range being $500,000 to $2 million. But the company would not issue 7 and 8. In other words, if this case hadn't been decided before February 28th, Note 7 would come out. If the case was decided on February 1st, Note 7 would not have come out. Note 8 would come out instead. Also consider the dollar amount. The reason I chose $2 million for this example and not $500,000 is because subsequent events have to be material. They have to affect investors. So for example, if you're going to lose a $10,000 lawsuit and you have a multi-million-dollar company, you don't have to disclose that just because you don't have to waste investors' time. But if this is a big thing to the company, and $2 million often is, and it happened before the financial statements were issued, but it happened in the next year, you still have to disclose it like this. This means that investors who are considering the 2015 financial statements know about it. Then it says the company plans to appeal, which you would hope, the investors would hope that happened. And I've written some things I've just talked to you about. I've written to you about how the note done after 2015, but before 2015 financial statement is released, could look like the timeline I have at the bottom of the page. Last note is payroll liabilities, and I don't have much to say about them. There are 3 main types: wages payable, withholdings payable, and payroll taxes payable. And whatever kind of payable you have, you saw these in Principles of Accounting, they're always current. Ask yourself this question: would an employee, that should have read employee there, not employer, but would an employee or a government wait more than a year for payment? No. So anytime you have payroll liabilities, these are current. All right, take care, and I wish you luck.